Ladies and gentlemen, in the last video, I explained why Tesla stock could be a $400-ish stock by the end of this upcoming week. Now, here in this video, I will go over all of the incoming data that we have, the good and bad you need to know about this week. Now, keep in mind, I think things are going to be pretty good into year end. I think there's a lot of reasons for people to be optimistic. I think ultimately there's going to be a lot of reasons to be optimistic in 2025 as long as we don't have a recession. But here in this video, I will do something that a lot of people are not doing right now. I will acknowledge the risk to this market and the risk in the data that we're going to get. Even though I don't think things are going to be bad this week, you always want to acknowledge the what ifs. What if this week is bad? What if this is the start to a bad December? Because maybe I'm just like living in my own little world here, but things look pretty good. A lot of people on X are getting nervous about what December could mean for markets. I think there's a little bit of PTSD from 2018 when you had a pretty aggressive sell-off in December, really from October 3rd through Christmas Eve, December 24th. But mostly throughout the month of December, you've seen the S&P fall about 20%, and that had to do with some of Trump's tariff policies before, and I'll kind of clear the air on why I'm not concerned about that for December, nor really for 2025, but there will be a moment in time where things get a little contemptuous, if that's a word, a little bit of issues will come about at some point. We'll talk about that here in this video. So let's get into it. Hit the like button and subscribe to the channel if you have not done so already. If you guys want to come trade with us live in real time, check out that link down below in the description of this video. And keep in mind, we are only open for trading Monday, Tuesday, Wednesday. We're not open Thursday. Happy Thanksgiving. And Friday, we have a half day. So most of the action is going to take place Monday, Tuesday, and Wednesday, specifically on Wednesday when we get a bunch of economic data. But we'll talk about that in just a moment. Because first, let's start with Monday, November 25th. That is tomorrow. You have Chicago Fed National Activity Index, expecting that's going to come in negative, but better than last month. That comes in 8:30 in the morning tomorrow. Dallas Fed Manufacturing Index is expected at 10:30 in the morning, and Wall Street thinks this is actually going to be positive. That would be really good to see some rebound in manufacturing. Now, manufacturing has been in a bad place for a while, but we have to acknowledge the reality. The reality is manufacturing is only about 20% of our economy, and services is about 80%. Now, this is different from where we were in like the 50s or 60s or even 70s for that matter, where things started to flip-flop. Because back then, over 50% of our economy was manufacturing. Now, you can see manufacturing weakness without it really, causing a recession. Now, things can snowball, right? And that's something to be watching for. Manufacturing, though, has been in a bad place for a while. So I don't think weak manufacturing data is really going to be the thing that causes markets to get more fearful from here, because it's been bad for a long time. That's all for your Monday. For Tuesday, you have your Red Book year over year and S&P Case-Shiller home price month over month and year over year. That could be important for some of your inflation data. You're actually expecting home prices month over month will be negative again, negative 0.1% to be precise. And year over year, home prices are expected to be up 4.5%, down from last month's 5.2%. That could be a good sign for housing inflation, although you calculate this using homeowners equivalent rents, and it's kind of a flawed way to calculate it just in and of itself. So hopefully they change how they calculate it, because it probably should be changed by now. 10 o'clock in the morning, you will get CB consumer confidence. This will be something a lot of people are paying attention to. You are expecting this will go up from last month of 108.7 up to about 112. So we'll see if consumer confidence goes up. That's always a good thing. New home sales month over month and for the month of October will be coming out, expecting new home sales month over month to be down negative 3.6% and home sales for October to be about 750,000 or so, 730,000 to be more precise. You will get Richmond Fed Manufacturing Index, expecting that to be negative still. Services revenue is expected to be positive 5, and manufacturing shipments expected to be negative 5. So that's I want to say important, but really it's not. You will get a movement in markets from that data, but I don't think it's anything that is a systemic risk. The FOMC minutes will come out on Tuesday. This is backwards looking. It's not incorporating recent events. So yes, the markets respond to this a little bit. This will come out at 2 p.m. on Tuesday, but it's not going to be the biggest deal. Really, what's going to dictate this week is Wednesday. We will get core PCE price index month over month, expecting this to come in at positive 0.3%. Now, this is the same as went up last month at 0.0 or 0.3%. 0.3% times 12 is 3.6%. So that's higher than where you want to be. The difference between 0.3 and 0.2 is quite a big one, because 0.2, you're running at 2.4% year over year. That's a much better rate. If you start to sprinkle in 0.2s and 0.1s for a couple months, you're going to be at 2% inflation. So I think you're at a pretty important level right now as far as the inflation data, that if it ramps higher from here for a couple of months, you're going to be in a bad scenario for the Fed. The Fed may have to consider raising rates again if inflation does spike for a prolonged period. Okay. Now, do I think that's going to happen? No, I think Trump's actually going to induce lower than expected inflation, but this is a risk to the markets, especially coming this week. If the data does come in hot, Wall Street will start to get nervous. Wall Street's like a nervous cat, okay? It takes a while to get Wall Street to warm up to things or to consider the risks, okay? And that's a risk, a big one for this week, is hotter than expected PCE data. If that comes in at like 0.4%, we have a big problem. Durable goods orders month over month. I don't think this is as important, but you are expecting a positive number following last month's really bad number. GDP growth rate quarter over quarter, second estimate for Q3, expecting that at 2.8%. Last estimate we had was 3%. Again, I don't think that's a hugely important catalyst because I think it's pretty forecastable. I don't think it's going to come to us as a big surprise. If anything, you might come in a little bit stronger. Personal income month over month, expecting 0.3%, the same as last month. Really don't think that's a big catalyst either. But personal spending month over month is a big deal. Last month, you were positive 0.5%. You are expecting positive 0.4%. And why this is such a big deal is because 73% of the economy is comprised of people spending money. So if spending slows down, that's a big problem for markets and could be a problem for corporate profitability. Now, initial jobless claims are also coming out Wednesday. All of this data 8:30 in the morning, by the way. Expecting 215,000. Last week, you surprised to the downside at 213,000. One reason why small caps and Tesla and other economically sensitive stocks did well. You will also get continuing jobless claims as well, 8:30 in the morning. And then at 9:45 in the morning, you will get Chicago PMIs. Chicago PMIs are usually important, but on a day like today or Wednesday, when you're getting so much economic data, I'm not certain it's going to be the most important catalyst. Then you'll get pending home sales month over month and year over year. And that wraps it up for your Wednesday. Heading into Thursday, markets are closed. And Friday, you are really not going to get much data at all. Some data out of Canada, some data out of Europe, but Friday is only going to be a half day. And I really think Wednesday is going to determine or could determine markets until the next big catalyst, specifically that PCE number. If that comes in on the lower side, markets are going to get very optimistic heading into the end of this year. If we come in line with expectations, I think optimism can continue. But if we miss and PCE comes in higher, we are going to have a problem on our hands for the markets. And we really haven't faced a problem in a while. I also think one of the biggest risks to our markets and to Tesla is just this whole narrative of sell the inauguration. Now, the inauguration on January 20th, I think could be the cataclysm event where things actually, get much better or much worse. I think you could actually see a sell the 2025 kind of situation as you start 2025 that is really a sell the inauguration just happening a couple of weeks early. But at this point, I think there's a lot of people that are like, December is going to be bad for this reason or that reason, really just because 2025 has high expectations. I don't really see the catalyst to cause that as long as PCE comes in good. Now, the Fed is on December 18th. I think it's pretty forecastable as well what the Fed's going to give us. They're kind of going to, be cautious. They're not going to dictate any, preset policy path. They could be a little bit more bearish than we'd like, but we have a while until December 18th. So between now and then, I think markets can do well, and I think Tesla specifically will do well. We also have this week's earnings lineup, and Monday and after hours you have Zoom. That's going to be your biggest one. Tuesday is really the big day as well for generalized earnings. You have Abercrombie & Fitch, Kohl's, Best Buy, Macy's, Dick's Sporting Goods, Burlington, Analog Devices, and a couple of others in the morning. In after hours on Tuesday, you have Dell, CrowdStrike, Workday, Autodesk, HP, Urban Outfitters, and Umbrella that will report earnings. Specifically, Dell's going to be a big one, Workday, CrowdStrike, Autodesk. Like most of these companies reporting are going to be important. Best Buy, Kohl's, Abercrombie, Macy's, they're going to tell us a little bit more about the consumer. And Wall Street always likes to know more about the consumer. The consumer is so important that, any good or bad signs can really impact our markets. Now, with that said, before we go ahead and wrap up this video, I want to share with you this clip. It says markets will finish strong this year after clearing several hurdles, says 314's Warren Pies. This is someone that I respect quite a bit. Not afraid to share a contrary opinion when it's due. And I almost think being bullish on markets into year end is starting to be a little contrarian, which makes me a little bit more bullish, as I typically am a contrarian by nature.
Will these favorable trends remain investors' friend as we enter an even stronger seasonal period with the bulls' confidence riding high? Well, that's Warren Pies, co-founder of 314 Research. Warren, great to see you. Thanks for coming on today.
Yeah, thank you for having me.
So as I gather, Warren, you're kind of not in the mood to necessarily fight this uptrend as we face the last several weeks of this year. It just seems like you have the fundamental case. The Fed is in this kind of orderly easing process. Obviously, the market technically has held this nice trend. Is that accurate? I guess what would you be looking for to come next?
Yeah, I think that is basically accurate. The market's cleared a lot of, I think, concerning hurdles here, and now we're stuck with like the most seasonally bullish period of the year. So the election's behind us. Earnings, for the most part, now are behind us. The Fed is cutting, so that was all anticipated events. When you go back to the beginning of this year, and this is the dynamic we've been talking about and been talking with you and on this network for the better part of this year, is that strategists, investors in general, were just pessimistic on the bull market coming into 2024. Strategists forecast back then, 1 year ago, implied 2% gains for the S&P 500. And so our view is that this was going to create a chase dynamic throughout the year. And so all the pullbacks are shallow, they're quickly bought, everybody has to catch up. And now we're in this seasonal bullish window. You can't fade this. I think that the market's set up to have a strong finish, even though we didn't get that Q3 correction. And so, yeah, I'm not going to fade that, but I am starting to look ahead at 2025 and see some risks out there.
And we are showing this chart that you made that tracks the strategist consensus target for the S&P 500. And you have these end of year jumps in the projected target level, obviously, as strategists come out and refresh their outlooks for the coming year. Is this now at a level that you would be concerned? Let's say the consensus is looking for about 11% return to 2025, or is it just the fact that kind of everybody is revising higher?
Yeah, it is an area where I'm starting to get concerned. And so let's just, for a moment, we have to get all the strategist targets in there to to really have a full view of what's happening. So, but the early returns are in, and like I said, last year strategists made the mistake of being too keeping their targets too low and just being too bearish for 2024. And they're not going to make that mistake again, it seems. So the early targets we're seeing is like 6,600 for the 2025 target. And from current target levels, that's a 20% increase and 11% implied gain, as you mentioned, for the S&P 500. And both of those numbers are basically the highest we've seen at this point. You always get this rise at this point. This would be the biggest jump we see as we roll into a new calendar year. So we went from just skepticism coming into 2024 to a lot of optimism going into 2025. And that is the condition you see for, don't want to be alarmist, but that's what you see around major market tops. Every one of the bear markets we've seen for the last 25 years has started with strategists well above S&P 500 spot levels. So if this is where the rest of the strategists come in on their targets, then yeah, this is a concerning backdrop, and it makes the market more.
And I really wanted to share that with you because I think that's 100% accurate. I think we're going to have a pretty aggressive, pretty deep correction, 10 to 20% at least in Q1 of 2025. Now, I agree with the whole sentiment getting too optimistic for next year, but I really think it's just what areas we're talking about. I think the S&P to be forecasting a gain like that's insane because I don't think big tech's going to be participating much of next year. So really to get to 6,600 on the SPY next year, or higher than that as some targets are, in my opinion, you would need to see a crazy big broadening out of our markets because big tech's 40% of the index. And if the 40% of the index underperforms, you need to see a crazy broadening out. Now that could happen, but I really just think it's going to be a stock picker's market next year. I don't think it's going to be terrible as long as we don't have a recession, but I don't think the index is going to do all that well. I think it's going to be cyclical, small caps, mid caps, and selective big tech names like Tesla. I think Tesla will do very well next year. It could be a $600 to $800 stock by the end of the year. But you do have that risk that all these strategists are getting too bullish. Again, it doesn't mean a bad year next year. That just means if you're in the index, you could have a bad year next year. Now, again, a recession's the big wild card for next year. And I don't have the answer to that. Do we have a soft landing? Do we have a recession? I have no idea what happens with inflation and tariffs. I clearly have no idea. But I'm optimistic that Trump does not want to crash the U.S. economy. I'm optimistic that Trump does not want a recession in which deep 60% blanket tariffs on China would do that. I think Wall Street's a little too concerned about some of these things and underplaying risks of others like concentration and valuations, right? Valuations in the immediate term from now into year end, I don't think are a big issue. But in 2025, big tech valuations are a big issue. And that's why I think big tech's going to underperform. And that's why I think it's really going to be a stock picker's market for next year. So definitely some risks on the horizon. As I've said before here on this channel, you just need to be open-minded to these risks. No matter if you're the biggest bull on Wall Street, you should be open-minded to risks positively or negatively. And I think what that means right now is raising as much cash as you possibly can. Not because something's guaranteed to go wrong, but because there is a higher chance that something could go wrong as people are expecting things to go so right. So let me know what you think about this information down below in the comment section. That's going to do it for this video. Have a great rest of your day, and I will see you in the next one.